Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Thank you for joining us for another edition of our market update for August. When you watch this video, it's going to probably be after Labor Day, so I hope everybody had a wonderful Labor Day. A lot of people think of Labor Day as the end of summer. Not here in Florida, of course, but most places it is. But hopefully it's not the end of fun. There's going to be a little bit more fun in store for you in our video. Alright, maybe not fun, but at least interesting, right? If you're joining us for the first time, thank you for joining us. I hope you find it interesting. Please feel free to reach out to me if you have any questions. Thank you for tuning in and enjoy. Alright, let's get things kick-started with the asset class returns. When you first look at the chart, it looks pretty good. And it has. It's been another good month overall. Looking at large cap stocks to start, this was really led mostly by large cap tech stocks. So it's been interesting. The large cap value stocks have not been doing as well, but the S&P still keeps going up because of large cap tech. And it seems like when one isn't doing well, the other is. So it's been pretty strong year so far with large cap, up 3% for the month, over 20% year to date, which is pretty surprising. We've had the Delta variant and all the stuff going on in Afghanistan and still going pretty strong, so that's been impressive. Small cap has been doing well, not quite as well this month. Again, they tend to be a little bit more cyclical with the economy, a little bit more sensitive, and that Delta variant has been kind of hitting some of those small cap stocks a little harder, but still up 2% and a whopping 23 for the year, which is great. Real estate has been doing well, continues to do well, up 2.81 for the month, a whopping 32 plus for the year. Real estate's really finally found its groove. It did pretty bad last year with all the shutdowns from coronavirus, but as things gradually reopen, you're starting to see the benefits there. On the international front, things not as good. Developed international was up 1.75, not too shabby, up 12 plus for the year. And emerging markets up 2.95, a little bit better as things start to improve, especially with China. Last month was horrible for emerging markets, and a lot of it was because of China. They're doing all kinds of regulatory crackdowns, especially on their tech. That's been hurting their markets, which is why they're only up 5.54 for the year. But overall, the story on international is the dollar's doing great. So when the dollar does great and you convert it over to these other currencies, or in reverse, you convert the other currencies back to the dollar, it hurts the performance for American clients. So that's one of the biggest reasons why you see the lag. On the fixed income, kind of a boring story here, only up 0.01. I guess that's what it's supposed to be, right? Kind of boring. Down a little bit for the year on the high grade fixed income. The lower grade fixed income doing a little better, up 0.5 or 4.5, and for the year almost 4. Not too bad. And gold again down. Gold down 0.62 for the month, down over 7% for the year. Gold has been an interesting story. Maybe with the Fed starting to taper, things that will be a catalyst for some change there. We'll have to see. It just depends on how the market reacts. If the economy gets hit too bad, that would actually be good for gold. If interest rates just start going up and the economy can continue to be strong, it could be really bad for gold. So we'll be monitoring that closely. But thankfully, the areas that have been doing really well for the year and for the month, we've had good exposure to. So I'm very thankful for that. So that's the conclusion for the asset class returns. All right, so you heard me talking about the COVID numbers still being high. I don't think that's breaking news for you. Certainly it's been all over the news, and it has been pretty bad. But I do want to show you what's going on here in Florida. Now, Florida has been really the epicenter to a lot of the COVID variant. And if you could see on this chart here, that it looks like Florida is now peaking. It got even worse than it did in the regular COVID outbreak over the winter and last summer, which is pretty amazing. Luckily, the deaths haven't been as bad, but still, it disrupts the economy, right? And I think we saw that with some of the economic numbers, and also with the numbers that came out today from jobs, which we'll talk more about that. But if you can look at my arrow here, it's definitely trending back down. So are we at the peak of the variant? I hope so. It seems to be happening in Texas and in Florida. Maybe not so much for the whole country, but I think we're maybe on the leading edge of this. We shall see. The next piece here is the Delta variant deja vu. All right, so what do I mean by this? Well, if you guys remember last summer when we were at the worst of the lockdowns because of coronavirus, it was the tech stocks that actually did really well because interest rates were super low and staying low, and they were still doing business, right? And so what we're seeing is a little bit of deja vu of what happened back then. This chart, I tried to blow it up here in this section. You could see that when growth stocks are more expensive, the line goes down, and when value stocks are more expensive, the line goes up. You can see here the green dot is where we are now. We're at the lowest part of that chart, which means that growth stocks have gotten more expensive again. And so over the last 2 or 3 months, because of the Delta variant, we're actually kind of reverting back to what worked last summer. But again, we'll talk more about this in my outlook. But my thesis is that this is temporary. This is more of a speed bump. So it's maybe a good opportunity to pick up the value cyclical type stocks and maybe start to take a little bit of that growth stock profit off the table. We'll see. So the leading indicators continue to slow down. Some people are getting a little nervous about that. It's usually a sign that things are going to get worse. But I think, again, it's more of a temporary Delta variant woe. You might be able to see this here. You can see this is consumer confidence take a pretty big hit. And consumer confidence and a lot of other leading indicators are kind of showing the same thing. But instead of panicking and thinking we're going through last summer all over again, I think this is probably more just a speed bump. I might be wrong. The Delta variant might persist a little bit longer. Maybe Florida is not a leading indicator of what the rest of the country is going to look like. Maybe there's new variants. There's still a lot of what ifs. So obviously we got to take a day at a time and keep a close eye on this. But again, I think this is probably more of a temporary blip. We'll see. All right, here is the market update. So a quick review, and then I'll get into more of the details in the next slides. We're going to start talking about the COVID cases. They're still pretty high. There are some slivers of hope that I want to talk about there. The Delta variant deja vu. All right, I'm going to leave that one as a cliffhanger, so you have to keep watching, see what that's all about. And leading indicators continue to slow down. That was the theme of last month carrying over into this month. But again, some slivers of hope with the claims numbers that came out on Thursday. And we'll talk a little bit more about that. So keep watching. All right, if you've hung around this long, you will be treated well because the market outlook, I think, is very meaty here this month. We're going to have some good stuff. We're going to be talking about the vaccination rates and the economic potential, a little bit of a thesis I'm developing here. We also are going to talk about September and how this marks the end of the payroll subsidy and all its ramifications. Pretty big deal potentially. The Fed will be tapering soon. We don't know exactly when, probably before year end, but that talk is going to continue, and what are the ramifications there? And of course, what are the investment implications? What is Hartwood doing to kind of address these different outlooks? All right, get ready. Okay, the first part of the outlook is pretty simple. Just follow the vaccination rates. As you can see by this chart here, the United States Europe, and China now too, has the highest vaccination rates in the globe. And so whoever is taking care of the coronavirus the best is going to have the best recovery and initially the best economies. And so right now, that's one of the reasons why you're seeing the U.S. and Canada do pretty well. They've been vaccinating pretty well, and the rates are high. We're seeing that also in Europe. In fact, Europe has even better vaccination rates in most of the continent than the U.S. China is hanging in there too, actually doing pretty well. So you could see that the recoveries are going to be coming from there first. Now you can also think a little contrary and think emerging markets in general not doing as well can maybe be next year's big recovery. We'll be developing more of that as we go, but good thing to think about. The second part of the outlook is the federal unemployment insurance is ending in September. I think this could be a pretty big deal, a nice catalyst. What's happening in September, which is pretty much now, the federal unemployment insurance, which was paying an extra $300 per week, is because of the the act that was passed and was extended recently by Congress. This extra money is going to expire. So a lot of people, I think, are going to find themselves wanting to get back to work. Now, I show this chart here that shows how many job openings there are available. This is a record high. We have over 10 million jobs available, and we still have tons of people out of work. So if September forces a lot of people to get back to work because the benefits are cut, I think a couple things are going to happen. There's going to be huge spikes in employment. People are going to be getting back to work. Restaurants are going to be reopening. Things I think are going to dramatically improve in the economy. I think that'll also force more people to get vaccinated. So this would be, I think, a catalyst for a lot of good things for the market. So this is where I think this trend of growth stocks outperforming the value and the cyclical stocks could maybe shift a little bit here in the month of September. If it doesn't, then definitely there's something else going on that we'll have to reconsider. But you can see how this could be a potential big change. Now, also the Federal Reserve is talking about tapering here before year end. You might wonder, well, why is this in the outlook? Well, it's in the outlook because if they do begin to start tapering, which if you remember, they've been buying bonds in the open market, basically creating money in a way by buying bonds in the open market. If they're going to start buying less bonds in the open market, less demand for bonds, means that interest rates could start going up in those bonds that they were previously buying. And if interest rates start going up, that could affect the economy. So, of course, they don't want to do that until the economy is pretty strong. So, A, they think the economy is getting pretty strong, which is why they're comfortable doing that. And as those interest rates go up, it's going to shift the kinds of stocks that are going to do well, because certain types of stocks and bonds and different kind of asset classes are more sensitive to interest rates than others. Again, this goes along with the theme of those cyclical stocks and those international stocks could actually start to do a little bit better as those yields go up and as the economy continues to improve. So this is actually another potential catalyst for that rotation back to those value stocks. Seems like I've been beating a dead horse on this, but I think a lot of things are going to start to look a little different here in the month of September. We shall see. Now for the last slide, it's basically what investment implications there are and what Hartwood is doing. I think if you watch the whole video, you kind of get a pretty good idea of what I've been saying, so I don't need to reiterate everything. But basically, we're going to keep rebalancing. There's still a lot of risks out there, although we're cautiously optimistic about some of the things that might be coming here shortly. As we rebalance right now, we're selling a little bit of those expensive stocks that have gone up a lot, especially over the last few months, and just going back into some of those stocks and some cash and bonds, things they're going to stabilize the portfolio and that has the best opportunity to continue to move upwards. That's maybe not quite as expensive. So we can get more into specifics. Give me a call. I'll be happy to chat with you about it. But thanks again for watching the video. Thank you for inviting and sending this to your friends. Feel free to comment below. We are checking that, so we'd love to hear what you're thinking. See you again.